Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the first Better System Trader podcast episode for 2018. Happy New Year. I hope that you had a great Christmas or holiday season and I wish you all the best for 2018. Now, as I mentioned in my emails, there are a few changes to Better System Trader this year. If you're not on the email list, I do highly recommend that you join us so that you don't miss out on anything, or alternatively, keep an eye out on the website, bettersystemtrader.com. There will be lots of additional content posted on there throughout the year. In this podcast episode, we're investigating the impacts that large institutions can have on the markets, especially on stocks, and how certain institutional behaviours can indicate potentially big moves in prices. And to join the discussion today, we have Jason Bodner from Macro Analytics for Professionals, who specialise in looking at unusual institutional activity to identify which stocks the really big investors are moving their money into and out of. We'll hear a little bit more about Jason's background in a sec, but his previous experience working some big institutional orders has given him some valuable insights that I'm sure we can all find useful. So in our discussion today, you're going to hear how institutional activity can indicate potentially big moves and the signals to look out for, how the techniques of scouting out players on a sports team can apply to stock selection, 3 basic factors that can quickly identify when institutions are potentially working a big trade, plus loads of other signals to watch out for as well. How mixing technicals with fundamental factors can give you a more complete picture than just technicals or fundamentals alone, plus much more. So let's get started. Hi Jason, thanks a lot for joining us today. It's really great to have you here.
Thanks, Andrew. Thanks for having me.
Awesome. Well, how about we just get started with a little bit of your background first. So can you tell us a little bit about how you first got started in trading?
Yeah, sure. I should probably start at the very beginning. After I graduated college, I actually went to play music professionally. I started in bands. I ended up in New York City writing music for television commercials and fashion shows. And I was lucky enough to work for 9 months on one of the ballets for Alvin Ailey American Dance Theater. At the time, it was the world's most popular touring dance company. It was a major project, took a ton of time, and I was the co-composer and conductor in Lincoln Center for 4 nights. And for all that effort, which was a phenomenal experience, I was paid the princely sum of $1,500. So at that point, I decided to appeal to my capitalist inside of me. I went into finance, and I ended up landing a job as a assistant on a trading desk for Cantor Fitzgerald in London. There was a young equity derivatives business, and it was fortunate timing for me, but unfortunate timing overall. It was right around September 11th of 2001. Mm-hmm. I had moved to Europe just a month before, and Cantor Fitzgerald in the U.S. had lost most of its employees. So I flew back to New York around September 18th, holding my hand up to try and rebuild the desk. I stayed in New York for about 4 months with a junior's role. And when I moved back to London, my assistant role was gone. So it was kind of sink or swim. And I would say that is the moment that I really started to become immersed in trading, aside from, I had a lifelong curiosity about the stock market and currencies and all of that. But it wasn't until that moment that it was really sink or swim that it became professional for me.
Yeah, okay.
So let me add on to my initial experience of trading. When I became a sales trader for Cantor Fitzgerald. When I moved back to England, I was handling large institutional order flow for derivatives. The truth is, hedge funds and banks and all sorts of large participants would come in with orders. I would never really know what the genesis of the order was. I was handling it. And it always fascinated me to think about what happened to their trades before and after the fact. But the derivatives market is complex, and you don't always know. Is it a hedging trade? Is it a synthetic position? There are so many ways. The same trade could be profitable, but actually be an overall loser for someone if it's a hedge. But this really sparked my curiosity into personal trading. And my initial exposure, I would say, aside from having owned stocks when I was younger, to taking a view on speculative trading or investing, I opened an account where I could trade the currency. I was living in London. I could trade the dollar-pound exchange. And what's funny about that is I decided I was going to look at charts and look at all this information and just, use my gut and my instinct. And I was a trader and I was set, ready to go. But the reality was, I got euphoric and I bought the top, and it was literally the exact top, and I would watch the chart fall, and then I would go sell it, and then I'd watch it rip in my face, and I'd pound the desk. And I literally lost 19 trades out of 21.
Wow.
It was actually so bad that I found out after the fact that the guy sitting next to me was my boss, and he actually set up an account 10 times as large as my account because I was a junior, and he would trade the exact opposite. So he was killing it on my mistakes, and what made it worse was I was taking my paycheck from him and giving it back to him with my bad trades. So I think what's important here is I realized what type of trader I wasn't. I think there are a lot of great discretionary traders out there who can use gut and instinct and feel. I just was not one of them. I found that when I was trading on emotion, I was betraying myself. I was emptying my pockets. So it was at that moment really that I gave up for a while, but I sort of got the first inklings about what it meant to take a systematic approach to the markets.
Yeah.
So back then, my approach to the market was very sort of haphazard. It wasn't filled with a lot of data or analysis, quantitative analysis. I had no system in place. And for me, it was an expensive tuition.
Yeah.
Let's just say.
Yeah. And I guess also seeing that the institutional activity in your job there must have given you some really interesting insights into, I guess it's almost like behind the scenes. A lot of people probably don't get to see that. So I'm interested to know how did that kind of direct you towards what your overall approach to the markets today?
Yeah, okay. I would say that's a nice evolution to go over. But in the very beginning, this is another funny story. So when I came back to London, they were like, okay, you still have your job, but now you have to go make money and broker trades and generate ideas. And I really didn't know what I was doing. And my very first trade at the time was 250 contracts of Infineon, which was German stock. And I think that was the equivalent of 25,000 shares. It's not a very big trade over there. And something really funny happened. There was a huge trader in the market who was a client of the desk, and he decided he was paranoid and thought every broker was out to get him, and he wanted a complete neophyte, someone who knew nothing to cover him that he could mold into his own. So my very next trade was, I think it was 3 million shares of Vodafone. So it was a much larger trade. And I went from tiny to huge overnight. I still had no idea what I was doing, but what that enabled me to see was the amount of volume capable by these big institutions and what effect it had on the market. Because as soon as we consummated that deal, the phones started ringing from everyone who witnessed the trade in the market. Who traded that? Who was buying it? What was the genesis? Everybody wanted to know in the institutional community why. What's going on with the big trades? It's the big trades that catch the attention. So I think that was a little kernel that helped contribute to down the road. I said it's a bit of an evolution as to how I approached the institutional side. That was sort of the first genesis. Really what ended up happening was eventually, so I put my personal trading on the shelf and I started learning how to broker these much bigger trades and satisfy institutional clients. I was given the opportunity to take over the U.S. business, and sometime in 2007, I hired someone who I heard this guy knew how to trade. And quite frankly, you know, I needed a junior, I needed someone to assist with the desk, but it was somewhat selfishly motivated. I wanted to sponge knowledge off of him. And a great example, you know, a few weeks after he's working with me, he'd look at a stock, he'd pull it up and he'd say, oh, this is a great stock. It's going up. I'd be like, well, how do you know it's going up? And he couldn't really explain it to me. He just said, I don't know. It's just going up. And lo and behold, 2 weeks later, the thing was up 13%. And I thought he was a guru, a genius. And that's when we began our relationship. Ultimately, he became my business partner years down the road. But we started looking into the mechanics of the market and what made stocks go higher. We really separated it out into two buckets, looking at fundamentals of stocks and technicals of stocks. But in the very beginning, a very easy way to separate stocks is, you know, just like you're scouting out players on a sports team. You're looking for guys with the highest statistics, the strongest numbers, the best ability. Those are the guys you want on your team. And the guys you want to get rid of are the guys who are slumping, the guys who are weak. Their stats have been falling for the past 4 years. They're aging. You know, they're less use of your organization. We kind of started looking at stocks in the same way. So what did we want to see from a fundamental side is it's really kind of like technicals. It's trending, right? You want to see their revenues are growing. They're doing more sales. Their earnings are growing. They're making bigger and fatter profit margins over time. You know, these are growth companies that are firing on all cylinders. They're eating up market share. They're reducing their debt to equity ratios. There are all these great, strong fundamentals, and obviously the weak stocks would exhibit the others.
Yeah.
That was one way that he would look at that stock and tell me that it was going up in a week. And then we would get to the technical side of trying to look at volume and volatility. But it wasn't really until what I call my own aha moment that I really realized the power of institutional activity.
Okay, you've got me intrigued now. I'd like to hear a little bit about this aha moment, if you don't mind sharing it.
Well, sure. So, you know, the reality is this aha moment, we had no idea what was going on. I had no idea. I was running the desk. I had a friend who worked at a very large bank who, you know, again, my desk was handling transactions in derivatives. But in part of the derivatives umbrella, we would do various sorts of equity trades, just straight stock trades. Cantor was known for being able to place large volumes of stock. And he called me up and he said, look, I have this client behind me. I can't tell you any more about it, but if you have any sellers in this stock, let me know. I'm going to go ahead and call it XYZ stock. So I went out to my traders. Cantor at the time had 250 sales traders covering thousands of hedge funds. So we really had a very broad coverage of the U.S. equity market. I said, how many shares do you want? He said, just show me offers. I said, what level do you want to pay? He said, just show me offers. So we rustled up some sellers. I showed him 100,000 shares. He bought the stock right then and there. I guess that would be about $25 million worth of stock. $2.5 million worth of stock. I said, do you want any more? He said, show me offers. Long story short, by the end of the day, he had bought about 1 million shares of this stock through me. I had no idea who the final client was. And I was really elated. We made a great commission for the bank. I did a big trade. People were asking me questions. It felt very good. This was nothing in comparison to what I would see over the course of the next 20 trading days. So call it a month. This stock started rocketing higher. He bought volume through me. We started to see volume printing throughout the market elsewhere. Other big brokers were printing volume. We saw options volume printing. After a few days, and the initial sellers were run over because now the stock was much higher, it became clear that this was unlike any other order I had seen. So at the end of the month, when the order concluded, the only time the buying pressure came off, let's say the foot came off the gas pedal, was a 13F filing hit the tape, which was a stake of material ownership. Someone had to disclose that they own more than 10% of the company. And it was only then that I realized that an activist shareholder hedge fund was building a stake in a publicly traded company with billions of dollars of market cap. This was a multi-billion-dollar fund, and the stock had rallied, more than 50% in a month. So it became clear at that point that when an institution wants to step in and do something big, they can't always do it in one day.
Yeah.
They want to try and keep it quiet for a while. Maybe they'll go through several sources. So, I had handled myself maybe 6% of the float of the actual company, and this guy took maybe a 13% stake. This was the aha moment, to imagine billions of dollars passing through your hands of stock, and only once it's concluded do you actually realize what happened.
Yeah.
So at this moment, we found this trade, and I said, wow, this can't be the only guy. This has to happen all the time. Big institutions get in and out of stocks all the time. It doesn't always happen. If somebody wants to buy, 20 million shares of stock, it doesn't just happen in a block. Sometimes it can, but more often it doesn't. They work it over time. They rotate brokers. This is what my aha moment was, to look for and try and interpret historical information to turn that into a signal. And that sort of was the genesis of the rest of my career, what I've been spending my time on.
Yeah, as you mentioned there, they're trying to keep these activities quiet as long as possible. So it must be quite challenging at times to pick up on this early. So what kind of things are you looking for out there, or are there any kind of clues or patterns that people can kind of look out for that may indicate that something's happening?
Yeah, so probably on the most basic level, look, we touched on some of the fundamentals of the stock early on, but I would say 58% of the factors that I look at stocks on a daily basis, and we can talk a little bit more in depth on the level of analysis that I do later, but I would say almost 60% is looking at technical behavior. And probably the most basic ones that people can look out for is when a stock trades outside of its usual range, above average volume, and you're looking for big price gaps, up or down. That's a clear indication that someone is getting in or getting out of a stock. Now, the reality is if the demand outstrips the supply, or the supply outstrips the demand in a very basic level, that's going to determine a possible change of future direction. So I would venture to guess that an institution wouldn't step in and take, hundreds of millions of dollars worth of a stake in a company on the long side if they didn't think it was going to go up, or if they didn't know something. So good signals to look for are, let's look at average daily volume over a certain time period. Let's see let's look for the spikes. Maybe let's look at the historical volatility of a stock, its usual expected trading range. Let's look for where it trades outside that range. And then let's look for the price increase or decrease that's outside the normal increase or decrease range. And if you take those three very basic factors and layer them on top of each other, let's say if all three things flag, yes, this is outside the normal range, then that's a very good indication that something has changed.
So when you're actually comparing this kind of recent behaviours to past behaviour, how far back do you actually look to kind of get an indication that this is outside of normal behaviour? Do you find that there's more value looking a long way back, or maybe like a medium term kind of period, or what have you found there?
Well, to be fair, the analysis that I do daily, this is probably a good segue into how I look at all this data and how much data I look at, and I'll still answer the question. But
sure.
I look at more than 4,000 stocks in the U.S. alone every day, about 16,000 stocks globally. I pull about 200 data points per stock, and then I have, call it, 29 individual algorithms measuring various factors. And those 29 factors, that's what 58% of them are technical, and the remainder is fundamental. So within that technical, I'm looking at, to answer your question, I'm looking at a 52-week time frame. I'm looking at roughly 3 months. I'm looking at 1 week, 2 days. I'm looking at various different time frames that I find useful in my research.
Yep.
But typically, I like to look at sort of 20 days of average daily volume across a bunch of indicators. And that's sort of widely followed in the market. That's 1 month's trading. So if a stock's action today is unusual compared to its past 20 trading days, that's usually a very strong indication. I would say I found that very useful.
Yeah. Okay. So I think you just kind of mentioned price gaps and above average volume and above average volatility. Are there any other kind of technical indications that something could be happening?
Yeah. So let's look at some technicals that are important for the long side. So let's suppose I'm looking for a long candidate. I want to see the price is gapped higher. And by gap, again, I mean that price change is out of the ordinary compared to its prior time frame. Yep. If we're using 20 days in this example, I want to see that above average volume and above average volatility, like we just mentioned. But I also want to see, where's that stock trading related to some near interim highs? And I'll throw 3 months out there. Where's it trading related to its 3-month high? Where's it trading related to its 52-week high? I want to look at reported things like institutional support and ownership. You know, who owns this stuff? Is it widely held 20% by institutions, or have like 85% ownership is based on institutional support? Those are meaningful statistics to me. Trying to throw in a short-term indicator as well, I'll look at how high the short interest on a stock is. So if the stock's gapped up massive on big volume and big volatility, well, that's going to squeeze a lot of shorts, and I can expect that momentum to go higher. I want to look at how the moving averages are related to each other. If there's a bunch of, convergence between, I like to look at a 200-day moving average, a 100-day moving average, and a 50-day moving average. So typically what I'll like to see to the bull side is the 50 days higher than the 100-day and higher than the 200-day, and there's sort of a reasonable equilibrium of space between those, because then we're going to expect trending higher. And then, I'll look at other things as well that I consider more technical, like how does the stock perform relative to its sector? Yeah. How is the sector performing relative to its benchmark index? How is the stock performing relative to its industry group, its subsector? Are we looking at a stock that is one of 30 internet retail stocks that all just showed me a similar signal? Is that indicative of someone stepping in and buying an entire sector exposure? So I can get pretty granular on the level of analysis, but these are some of the things that I'll look at on a factor basis.
Yeah. I think it's interesting as well that you use a combination of fundamentals and technicals, because I think people probably gravitate to one or the other, and perhaps maybe the mixing of the two isn't so common. How much of a difference do you think it makes to your approach, including fundamentals with technicals compared to perhaps just technicals or just fundamentals?
Yeah, I think that's a great question. Here's the best way I like to think about it. You have 4,000 stocks, and I'm a bit of a stats geek at times, and I like to think of things as sort of like a normal distribution curve. Like if you think about your neighborhood that you live in, probably most of the people are going to cluster around the same height. Let's call it, 5'10" for men. You would expect on the extreme ends of the curve, there would be only a few people who are 7 feet tall and a few people who are 4 feet tall. So you get this nice normal bell curve distribution. I like to live my analytical life in stocks in the tails because I believe that's where the alpha lives. And by that, I mean the outperformance of stocks to the long side are going to occur at the right side of the distribution curve. That's going to be your best stocks. And the weakest ones at the bottom are going to drag the market down. So we might be looking under the hood of an S&P 500 index that's flat for 4 months. But during that time, real estate might have been the leading sector, which was up 14%. And I'll throw it out there, energy might have been the weakest sector, which was down 14%. You see? So under the hood of a static market, you're still going to have leaders and laggards. So going back to your question about fundamentals and technicals, well, that technical aha was huge. It helped me visualize and contextualize the importance of taking into account basically a change in market dynamics. We can call it unusual institutional activity. We can call it whatever we want. But if all of a sudden a stock changes direction dramatically, supply outweighs demand, stock gaps up, volume spikes up, volatility is blown out, there's a good bet it's going to go higher. So I just tried to refine that, looking really for unusual institutional activity. But what does that mean? So if I just get that signal on a stock, and it's a stock that's deep in debt and just emerged from bankruptcy and still is facing a lot of headwinds in terms of competition from the market and shrinking demand for its products, that doesn't necessarily mean I want to own it. But if it is a stock where they just announced that, let's just call it, they have the most innovative technology in its space, they're the market leader, they're growing earnings, they're growing revenues, they're doing everything right. And you couple with that a change in market dynamics and possible unusual institutional activity, and it's attracting the interest of big players. That, to me, means more than anything. So, Andrew, I think this is a great segue into poker. And if you allow me to talk about poker just for a second, and like I did in a prior presentation.
Sure.
A lot of people think poker is just a game of chance, and guys like to sit around in the garage and, splash money into the pot and see if they can win. But the reality is, if you look at the World Series of Poker and people who win bracelets year after year after year, like Daniel Negreanu and all these other poker players, I think there was a statistic I looked at recently that the top 20 world poker players have won more than $400 million.
Wow.
So are these guys just lucky day after day after day and doing this for a living, or have they figured out how to extract an edge? Mm-hmm. And the same could be said for money managers and people trading the markets. And I'm sure a lot of listeners work on systematic trading because they've identified an edge that they can exploit over time. So my systematic edge that I've learned how to exploit is let's look at all the stocks in the universe. Let's rank their health from weakest to strongest in terms of the fundamentals of the company. And then I'm going to look for those technicals, that price, volume, volatility, where they trade in interim highs and lows. And I'm going to look for that unusual institutional accumulation signal to couple with the strongest stocks for the long side, and look for big old selling, weak, really poor stocks for the short side. And that's pretty much the overall why we use both fundamentals and technicals.
Yeah. I guess there are also some challenges with fundamental data. For example, there can be some lag or revisions to numbers, and perhaps even some creative accounting or reporting, you could say. How do you manage those kind of challenges with fundamental data?
Yeah, we try and look at gap stuff, number one. The other thing, it's important you bring that up, and I'll go back to the fact that we look at roughly 60% technicals, and a good reason is because you can expect up to a 3-month lag in fundamental data. It can be stale, but technical data, I think it's important to say everything I look at, anyone can look at. I look at historical, publicly available data. You can theoretically replicate my model if you knew the inputs by going and scraping different sources on the web or, Quandl, wherever you get data. But I look at close-on-close data. So nothing really happens during the day. All my fun begins once the local markets close. And those data is sweet. So looking at that technical data is very fresh, right? So all we can do is go on the basis of publicly available fundamental data. And why it's important to do that as well is, as you pointed out, the problem is it lags. There could be creative accounting. There could be this or that. But overall, everybody out there in the market, unless they have vast resources and do deep dive analysis and are devoting full-time employees to digging in filings and everything, everybody's going on the basis of the word of the company. And granted, that can change over time, but if everybody, or at least an overwhelming majority of market participants, are using that data, it's kind of good enough for me to organize on a broad scale of thousands of stocks, which are strong and which are weak. And then I'm going to put more weight on the stuff I can actually observe with my eyes every day. Technical strength, how's it been trading over time, and all the stuff we already went into.
Okay, I just want to ask you a little bit more about volume, because it's one of the key factors in what you're doing. What about volumes or the volume of shares that are traded in dark pools and things like that? Do you actually consider that in your approach, or how do you manage that?
Yeah, so I think that's a great, dark pools have gotten a lot of attention over the past few years as algorithmic trading and sort of hush-hush trading attracts more attention. But the reality is, as I pointed out, everything happens after the market closes. So even volumes traded on dark pools are reported in the aggregate volume to the exchanges, which release the data at the end of the day, and you get an aggregate volume figure. So if it's traded in dark pools, it gets reported to tape by law, so I'll see it.
Yeah.
I don't pay attention specifically to segregated dark pool data or how things trade algorithmically. I just want to know on a broad level, hey, Andrew, this stock has been trading an average of 500,000 shares a day and trades in about a 50 basis point range. But today, once the dust settled and the market closed, this stock was up 8% and traded 8 million shares. Like that's gonna make me take notice. So in that 8 million shares is the dark pool volume, is the algo volume, is the block trade volume, the retail volume, everything. All that ancillary volume from other people noticing what's happening and hopping on board, etc.
Yeah. So when you're looking at that volume, do you actually take into account the number of trades, or do you try and identify if that's just a lot of retail traders doing a trade because someone mentioned it on Twitter, or it's because there's a bigger institution behind that? Do you consider those kind of things as well?
We take it into consideration, I think is a good way to say it. I don't spend an overly large amount of resources getting that granular. What we will take into consideration are announcements, like earnings or management changes, and how that coincides with volume on a particular stock day. But really, what I like to see is nothing on the news, nothing on the tweets and anything like that, and just see all of a sudden, out of the blue, something's changed here. And then, you're always going to get stories on CNBC, and you're always going to get Twitter stories after the fact, because everybody wants to be able to explain what happened. But the reality, let's go back to a moment, to that big trade, that aha moment. What was the coolest part, Andrew, was I mentioned we had 250 sales traders. After a few days of trading it, I started getting internal inquiries. Anybody know what's going on in XYZ stock? Who's buying? What's the deal? And obviously it was me. They knew I was the buyer. But there were other trades at times where I had to do things quietly, and my own sales force would ask me what was going on in a specific name, because people notice these things after time. So, what that points to is when guys come in to do something big, their hope is the first few days, they don't want anybody to notice, right? They don't want to ruin the picture for themselves. They want to try and mop up as much stock as low prices as possible, knowing full well they're going to outsize the market.
Yeah.
So that's the type of stuff we look for.
Yeah. Okay, just one final question before we start wrapping up for today. So this approach that you use, does it work outside of stocks in other markets as well?
I would say it probably works well in any market that has to have reported volume. And I would just sort of throw out the fundamental case. If we're going to look at, say, commodities, I think, this is also a good segue to some books that I liked, which I'll discuss in a moment. But if you look at commodity futures, they have to report volume at the end of the day. And some of the early trend traders used to look at volume and volatility. They would express it as average true range to sort of incorporate gap risk and overnight price changes. But they were very much driven by changes in volume. So I think it would work very well in that market. However, my particular approach of incorporating fundamentals and trying to further refine your investment candidates doesn't work as well in macro, because you have even a bigger lag of data and sort of a wider pool of participants, and the price of oil is moving for many more reasons that are harder to quantify, as opposed to looking at the latest earnings report of Amazon or something like that.
Yeah. Okay, cool. All right. Thanks, Jason. Well, I might just start wrapping up now with some quick closing questions. The first one, what's the biggest lesson you've learned through trading?
It's probably the most important thing is to recognize what kind of trader you are. And that can only really happen through trial and error. So I'm not an emotional trader. I'm not great at following my gut. I'm great at trawling through data, trying to stack odds in my favor and applying it to a system day after day after day, playing for the long term.
Yeah.
But the biggest lesson I learned was losing 19 times in a row, but I didn't give up. I didn't get back on the horse right away, but I did learn what I'm not. I think that was my biggest lesson as a trader.
Yeah. Okay, cool. And what is the best trading advice you've ever received?
Patience and price was always a big one from a great portfolio manager that I know. It's probably, honestly, keeping a cool head and sticking to your system, sticking to your guns. Because there are times where, let's say you're a long-only guy. Obviously, there are going to be times of extreme distress in the market, and you have to stick to your guns and stick to your beliefs and stick to your system, because you know in time things will turn around. And if you're trafficking in great growth stocks, they'll tend to be the first to bounce, something like that. I think it's having a plan and sticking to it is probably the best advice overall.
Great. Okay. And how about favorite trading books?
Yes. I think between that time I lost 19 trades in a row and the time I actually put my feet back in the water was a few years. And during that time, I read a bunch of books. Some of the books that I loved that story of the turtle trading exercise, Richard Dennis.
Yeah.
I think there's a book called The Turtle Trader, or The Complete Turtle Trader. There was a book about trend following, I think by the same author, Mike Covell.
Yep.
I read a book, How to Build a Fortune in Commodities by R.C. Allen. He was the guy who invented the ATR. I found that really interesting. I liked all the Market Wizards books. And, of course, no list would be complete without reminiscences of a stock operator.
Yep.
But I will tell you this. The book that probably had the most impact for me was a really short book. I think it was about 150 pages. It was called How I Made $2 Million in the Stock Market. And it was written in the 50s by a guy named Nick Darvis. And he was a professional ballroom dancer at the time. I won't ruin the book for you, but he essentially got paid in stock, forgot about it for a year, turned around, and all of a sudden realized it had, doubled in value, and he sold it to make a profit, and he was instantly hooked. And why it resonated with me is he started to listen to all the tips and the newsletters and this and that, and he ended up chewing himself up and lost a bunch of money. And then he decided to create a system. He created something called the Darvis boxes, and the stocks had to follow his system, and if they violated his system to the downside, he coldly and unemotionally cut his trades, and he proceeded in the 50s to make $2 million, which in today's dollars is a lot of money. So I found that book immensely informative, entertaining, and kind of life-changing in a way, believe it or not.
Yeah, I think all those books that you mentioned there are all classics, so a good selection of books to read. Okay, now what's the best way for listeners to learn more from you or to get in touch with you?
You can find me at my website at mapsignals.com. That's mapsignals.com. You can also email me at jbodner at mapletter.com. Those are the best ways to get a hold of me.
Okay, cool. Well, I'll have some links to those on the show notes page so people can find them easily. So thanks a lot for your time today, Jason. It's been great chatting to you. Now, is there anything else that you'd like to mention before we wrap this up?
Sure. Probably the one question we didn't go over, which I ask for people talking to me, is, does this method work? What is so great about it? Yeah. And on the website, you can find all sorts of white papers and examples that show the effectiveness of this. We've hired Ivy League graduate students in financial engineering. We've had about 10 of them let loose over our years of data, millions of data points, to lend statistical significance to what I'm saying here. And it's quite effective. We have a model portfolio that's outperformed the market over years. We've measured the effectiveness of the signal that we have uncovered. And it's really powerful stuff. So, I'm sure many of your listeners are into their own systems or trading other people's systems and have found effectiveness over time. And that is your edge. And that's why you have to apply it over time. So we have ours, and this is what we do.
Yep. Yeah, I actually went through all of those case studies as part of my research before our chat today, and I've found it very interesting. I got a lot of ideas out of that, and so I do recommend people go over and have a look at those and have a read through and see what Jason is talking about here, and maybe get some ideas for yourself and look into it further.
I think it's worth mentioning, Andrew, one last time. Sorry, the white papers are actually, don't ask me why, they're on a separate website, which is called mapletter.com. So if you go to Map Signals and you don't find it, you're going to think I'm crazy. So that's at a separate website. Mapletter.com is where you find those papers.
Yep, cool. I'll have a link to that as well so people can find that easily. All right, well, thanks a lot, Jason, for your time today. It was very interesting chatting to you, and we really do appreciate you sharing some insights with us. So thanks again, and all the best.
All right, thanks very much. I appreciate it.
All right, cheers. Bye-bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.